Good morning, traders. I have a very important video that I need to to share with you. And in case you haven't watched any of my analysis yet, I highly encourage you to go ahead and do so. In the video that I want to share with you today, it's a video that will either change your life forever, or if it's a video that will really change the way you look at things, and this should kind of steer you to um, a great direction. And if this video does help you, just feel free to check out my other videos and check me regularly. Anyhow, the thing I want to talk about today is the open range breakout, or a lot of time people just call it the ORB. And then the other component that I want to share with you also is the VWAP, which we all know, volume weighted average price. If you combine those two together, that becomes your best friend of all times. And I will talk about them in brief here, why it's really important, and why I feel like you need to know it, and why I feel like it's something that you should consider to be your best friend. In today's analysis, we are looking at a 15-minute chart on SPX. And why SPX? There's a lot of advantage trading index. I will let you explore some of those. You can read some of the blogs. I do have some of those out there as well if you have to look for those. But that's another topic. In today's chart, though, you can leave questions in the comments or anything. I will be happy to share with you. But what I'm looking at, or what we are looking at here, is a 15-minute chart on SPX. And on this chart, what we see here is that there are clear levels that are marked out. And before actually I go ahead and start the video officially, just do note that every now and there, I might have a phone ring, and then I will have to pause the recording for a second and get back and continue afterwards, just so you have that out there. But let's take a look here. We will talk about the days or the moments you need this open range breakout, and the moments you don't need this open range breakout. But I don't think there's a moment you don't need this. But this will allow us to identify which day we should participate in the market and which day we should not participate in the market. There are key points I will point out, and how this open range breakout could be really useful for us. There are people out there who are trying to chase the market, really not having any ideas on what you're supposed to do. And also there are people who are, you are so doubtful whether you should do something or whether you should not do something. But here's a breakdown, or here's your guide, or here's my trick. First of all, to begin with, open range breakout allows you to define the direction of the market in the first specified time frame of your choice. Like, for example, we're looking at the 15 minutes. That means on the first 15 minutes of the day, I want to know which direction the market is going to head to. Meaning, if the candle breaks above my open range breakout, I would consider that a bullish day within the first 15 minutes. But also, if the candle breaks below the open range breakout, I would consider that a bear day or a bearish day. But in addition to that, I have sprinkled onto my chart these three lines, the two green ones and one other blue lines in the middle. Those are VWAPs, but just on a different scale. Okay, so this is how it works. Let's zoom close enough. Not on this guy. Actually, I could actually lock this, so I'm not. Pretty much, I don't even need it. But let's lock that for now, so that we can utilize what we have here. Let's say we're taking a look at this. Okay, this particular day, which is August 15th. You see that the first 15 minutes of the day, the candle breaks. The candle breaks above, and then first thing first, we had the first candle had this tall wick, indicating that there's going to be a slight higher pullback on one direction. We just don't know what direction, but the open range breakout help us to identify that. And we do see that first 15 minutes followed by the next 15 minutes, or within the first 30 minutes, we have that breakout above the open range, but also above both every single lines of VWAP. Okay, the higher scale, medium, and lower scale of VWAP. we have that break above it, that indicates a strong upward or a strong uptrend. Okay, so you would consider that day or take that day serious as a bullish day, potential bullish day. But also, the important thing here that I want you to note is that look at how narrow the time frame here. Look at how narrow the width of that blue thick line is, which is our open range breakout. So if you can use something like this, you can manually draw your open range breakout. If you're supposed to draw your open range breakout, let me pause this for a moment. You would consider, set your time frame, and then consider the first candle, draw a line above the close. I mean, I draw a line at the close and at the open. That becomes those two lines. That becomes my open range breakout if I'm to draw them manually. Okay, um, the close and the open. Okay, you have that, so you know if it breaks above it, you are up for a good run. But if it breaks below it, you're up also for a good run on just on the opposite direction. With that in mind, that brings us to a point where we can start to go further into exploring this. Anyhow, let me go ahead and remove this lines because we don't need it. We have the one which is already auto drawn for us. This is just to illustrate if you want to manually draw those lines. So, with that in mind, you do note that there are days that really you don't know whether it's going to be a good day or it's going to be a bad day. Okay, but on most occasion, uptrends will highly have the first candle will mostly be green, but of course painted black. But not always. If you have it as red as this one is, check for the wick, and that wick just indicates or tells you the weight, the pullback, which is more likely to happen. Like I talked about the width, which is the distance between the closing and the opening price. If that is tight, that means you have quite a strong market. But if that is wide, the distance between the open and the close of the day, if it is wider, that means you might have a weak market. And so on that occasion, you need really strong confirmations. Okay. So in any ways, open range breakout, if you look at most of this, you'll see that most of this have worked really well. But on days like this, I normally tend to draw out my previous day high. Let me put it, my previous day high, which is around this, and my previous day low, which is around that. So with that, I would expect my trading by next day. I would expect my next day to kind of trade within this line, or if not within this line, I would expect price to open somewhere within this line and then go check the other end, which is in this case, we open in the middle, go check the previous day close, previous day high, and got rejected for a moment, came back and retested that resistance level from the previous day, and then went back and broke through. Okay, when you see this kind of retest and rejection, that's when you want to hop in as well. But either way, you are up for a good run based on just the beginning of how the day start. And you will just want, when you see that on the day, you want to put your stop loss below the previous week, a little below the previous week, say 2% below the previous week. And that's kind of what happens here. Although this week is a little taller, but that's pretty much what the open ring breakout will tell you. There are days that it will not work effectively, but what does those days look like? First of all, you have a wider distance between the closing and the open range of the open range is wider on the first candle, and that just tells you that it's going to be a little weak. And if there's a breakout, it's not going to last for long. You have days that I say the distance is really tight. That just tells us how strong the market is. And you see a good example of that right here. And when you look at this, you should be able to tell that this is going to trail in one direction. The blue line here, actually, I should paint it red. The blue line here is actually acting as a resistance level normally. If a candle, if the if the market goes and touches this, it should bounce off right away. But if it does cross below or above it, it should continue in that direction for some time before it bounces back. But if it bounces back and cross above it again, it should continue on that direction. And we can see that example. We can see that example uh, right here. If it closes below it, it should continue. Um, and here, like I said earlier, you wanna check your previous high and your previous low. Your previous high is just telling you that if you have to trade, price should try to obey the previous high, which is, say for example, is right here. Irrespective of where it opens, you open here, you break above, you want to set your target within the previous high. And then if it, the other way around, it opens and close below, you want to set your target below the previous low, right at the previous low, so that when you come around and reaches that level, you know for sure you have to exit because it's going to bounce. And a good example of that is right here. This day opens, we right to the previous day high. Previous day high, we reach that zone. I normally draw it as a zone. I will show you how here actually. It's better to draw it as a zone than as a line, because as a zone, it's just generic enough for you to consider. As long as the line touches any part of that zone, you know for sure it's something that you need to be cautious at that point. To draw it as a zone, normally what I do is that I change my chart type from the regular candle to Heikin-Ashi. But let's consider this day. This is August 22nd. We'll come back to August 22nd here. Let me change the chart in case it changes to something else. August 22nd, 28th, nope, 22nd, 22nd. All right, August 22nd. All right, at the August 22nd, what I would do, I get the tallest wick of the higher high, which in this case, the tallest wick is the first candle. I draw a line between that wick and the body of the candle and just touches slightly the body of the candle. And when I do that, that tells me the zone that the price should respect. And I do the same thing with the tallest wick on the lower low, which happened to be this candle right here for the previous day. And then I draw that as a zone, meaning price should respect this zone as well. So we see that price actually slightly open above that zone on the next day. But let's resume things to the regular candle. Actually, if we are to consider that, let's go ahead and put that out a little further so that we can go ahead and talk about that as we go without having to come back and redraw these zones every time. Okay, so this is another zone for a previous day high and previous day low, and same story here. Previous day high was right about here. Wait, what? Previous day high, let's say right about here. Okay, previous day high means just the next day should respect that zone. At least if it breaks above it, it should continue in that direction where it's broken to. And then we have the previous day low of that day, which was this candle here. This the highest, the wick of the previous day. And you see there's some consolidation here. That's just indicating a strong support and resistance level on that day. But if that level gets broken, it should continue to that direction for a little bit of time. Same story here. And this actually brings us today. Previous day high. Okay, let's just extend that. That might be a little, there might be some outliers there. And then we want to get or grab our previous day low, and we want to see how this translates actually to the regular candles right there. Okay, that's our previous day high, previous day low, and let's see how this actually translates into our actual well, we did skip this day, but you can tell if we just make this is the lower low of the day, previous day low. If we draw this and extend, you'll see that price opened right up around the previous day low, got rejected on the next day, and the previous day high was all the way up there. It did not make it, but there was this level of resistance on the previous day that became the next day resistance level. Let's go back to the hour regular candle, and let's see how that actually translates on the regular candle. On the regular candle, if we go back to this, you see that this day opens with the lower low, and of course the higher high was right around here. We had a higher high, which ultimately that was broken through. If we are to draw the zone around it, and also the lower low of the day was here, which was broken through, and this broke that, and so brings us to the point where the next day that followed that came, price open in the middle of the previous day and went and checked that zone and bounced off, bounced off here. And this point here, you want to also mark these points, or normally I mark this kind of intraday resistance level with a line, so that we know for sure that if price comes and touches those resistance level or support level, it should at least reverse on the other way around. And you know for sure if it does reverse, it's just going to stop at the previous day high, which ultimately you don't want to stay too long to wait for a breakthrough. It's because it will never break through. And we know if we look at this on a higher time frame, you will know that this is a consolidation zone. In the consolidation zone, really, you're looking for those opportunity that bounce off the higher high and the lower low of the previous day. You want to use the lower low and higher high of the previous day as your support and resistance level, and just base your trades around that. The next day here follows the same criteria. We have the previous day high, price opens at the previous day high. We know if it breaks above it and close above it, it should run. But it's not opening above, it's opening slightly, but closing below it, below the VWAP. And below the open range breakout. It's just right downward, and then comes and creates a lower low. The next day opens at the lower low. If it broke towards the lower low, it would have been great, but it broke above the lower low, meaning it should have some run. And again, same thing here. That thing, we have this level of resistance here. That resistance level became the current day resistance level, which was we had that resistance level right there, right here, and that became the current day resistance level. And that resistance level just kind of carried on. I'm not sure why, but it just kind of carried on. So you want to pay attention to those when you're approaching those levels. You want to see how the chart is behaving. There might be a lot of spinning stops. By spinning stops, I'm referring to this short-term consolidation on the intraday. Those are spinning stops. Those spinning stops are just indicating a reversal or a pullback at that point. And some of those pullbacks, intraday pullbacks or intraday reversal, really sometimes takes a lot of spinning stops for it to happen. And that actually took the whole day, and then it did happen the next day, where price opened at that previous resistance level and just rode and broke through the previous day low, actually, and continued to that direction. And that brings us to the point, which was yesterday. Price opened right here in the middle of the previous day, went ahead and broke through the previous day, previous resistance level, which is what we would expect it to bounce at. But note that entering that level, there was a lot of volume. We have this bullish engulfing candles that indicates that it's strong enough to break through. And right after we broke through, we had these spinning candles, spinning stops, which ultimately a little bit of consolidation. But that alone is tied to the zone, which is the higher high of some days back. That became, we want to keep that in mind, that it should respect those. So that got respected right there. So you want to refer back